This is an urgent investor alert from Elliot Yu and Roger Conrad. Warning, the views in this video are controversial, and some may find our financial predictions scary, even downright shocking. Believe me, we don't have any interest in frightening you. However, trends in the markets we've been warning about for more than 6 months are finally coming to a dangerous head. I know the production quality of this video is a little rough, but we simply can't afford to delay the release of our latest research. Not for one more minute. You see, this week, U.S. oil prices sank to 6-year lows, and most energy stocks plummeted alongside crude. However, this is only the beginning of a second leg of the energy investing crisis. A crisis that will touch oil services stocks, energy producers, big oil companies, and high-yield groups like the Master Limited Partnerships. Even popular, high-quality stocks like oil services giant Schlumberger, deepwater driller Emsco, oilfield equipment manufacturer National Oilwell Varco, oil giant ExxonMobil, and producers like Bakken Pioneer, Continental Resources. All of these names could easily see another 30 to 70% of downside over the next few months alone. Look, I know most energy firms, including the companies I just mentioned, put a brave face on the current oil price environment during recent quarterly earnings conference calls. However, while they're trying not to panic their shareholders, many are quietly preparing for the next wave of this crisis. According to a recent article in the Wall Street Journal, publicly traded U.S. and Canadian energy companies have raised more than $8.4 billion in capital since the beginning of 2015 alone by selling stock. Let's put that into perspective. In all of 2014, North American energy companies raised just $10.5 billion by issuing stock. And junk-rated energy companies have also borrowed nearly $5 billion in the bond market this year alone, nearly twice as much as the $2.7 billion of bonds sold at this same point in 2014. So let me ask you, why do you think these energy firms are building a massive financial war chest this year? Well, let me tell you. During the last oil price collapse in the late 2008 and early 2009, many energy companies struggled to borrow money and raise capital. They struggled to fund drilling projects, pay their bills, and make payroll. Some even went bankrupt. Look, energy companies know this isn't going to be a short-lived downturn in oil prices. They're raising capital while they can because they know very, very soon it will be too late. So that brings me to this. With all these savvy, well-known energy companies hunkering down and preparing for a prolonged downturn in oil prices, will you act now to protect your portfolio? I hope so, and that's why I created this video. In just a moment, I'm going to give you a chance to reserve a free copy of my latest research reports, detailing each of these simple profit steps you can take today to protect your wealth. In fact, we've never offered so many of our premium research reports, typically available only to paid-in-full subscribers, with absolutely no risk or obligation. I'm also going to do something I've never done before. We're taking these unprecedented steps because we're at a crucial crossroads in the energy markets today, right now. Just remember, no one believed me last year when I said oil prices would plummet below $50 per barrel by early 2015. And in February, some sneered when I said oil prices would see another leg lower to $30 per barrel and energy stocks would slump to new multi-year lows. Some even said I was foolish to miss out on a great buying opportunity. Yet today, with oil plummeting to 6-year lows, my forecasts are already coming true, and the dip buyers are licking their wounds. And many laughed when I advised selling deepwater driller Seadrill over a year ago, electric car manufacturer Tesla Motors last August, and high-yield MLP High Crush Partners just a few weeks ago in late November. Yet Seadrill is down 70%, while Tesla and High Crush are each off close to 30% since we advised readers and listeners to sell right away. And that brings us to today. So what can you do? Well, I've done a lot of research on this, and I found that there are a surprising number of simple things you can do to not only protect what you've currently got, but also to potentially make quite a bit of money as oil prices fall this year. Here are 5 simple steps I'm recommending. Profit step number 1, the energy market's ticking time bomb. The first step is to focus on preserving your wealth. You must avoid the energy stocks that are getting crushed in this bear market. Listen, just a few weeks ago, I received an email from a regular guest on my radio show, Capitalist Times Radio. He's a trader for one of the world's largest energy companies, a firm that's a household name to most Americans. I don't mean to be so vague and secretive, however, he's asked me to keep his company affiliation private. Like all my contacts in the energy industry, I always listen to what he has to say. But this email absolutely made my jaw drop. You see, this energy VIP told me that he just got back from a hunting trip with half a dozen other executives at major energy firms and master limited partnerships. As you can imagine, the conversations they had weren't just about deer. They also discussed a worrying trend underway in the energy industry right now. While it's related to the collapse in oil prices, energy producers like Continental Resources and oil services firms, it's actually far, far more dangerous. It's more worrying because it impacts a group of stocks that are enormously popular with income investors, and particularly investors looking for a way to earn safe income for retirement. I'm talking about midstream master limited partnerships, or MLPs. Just remember, these are the high-yield, tax-advantaged companies that own crucial basic energy-related infrastructure like pipelines, gas storage caverns, and oil terminals. These companies are often compared to toll takers. They charge fees to move and store oil, and those fees have no relationship whatsoever to the price of the oil they're transporting. Typically, these fees are locked in under long-term contracts. These contracts, in turn, contain provisions known as capacity reservation fees. In English, that means companies shipping oil have to pay the owner of the pipeline regardless of how much oil or gas they actually transport. Pay attention. Producers must pay the pipeline owner whether they ship thousands of barrels of oil per day or absolutely no oil at all. They must pay these capacity reservation fees whether oil trades for $150 or $30 per barrel. Sounds like an incredibly reliable and safe source of income and cash flows for the pipelines, right? But there's a nasty little catch. A very big risk my contact and his peers on this hunting trip discussed. A risk that's still a secret to most investors. You see, while many MLPs tout their long-term contracts, while these MLPs highlight the predictability of their distributions paid thanks to capacity reservation fees, some of these contracts aren't worth the paper they're written on. Listen, a year ago, many small producers in fast-growing shale basins were worried about having enough pipeline and storage capacity in place to handle all of the growing volumes of oil they were producing. In fact, the situation became so dire that oil produced in certain parts of the U.S., places like West Texas and North Dakota, traded at a $10, $20, or even $40 per barrel price discount to the exact same oil priced on the Gulf Coast. You see, there just wasn't enough pipeline capacity to accommodate America's shale boom. Gluts of crude developed in certain parts of the U.S., depressing prices. But with oil at $80, $90, or $100 a barrel, many of these smaller producers were rolling in cash. Banks were eager to lend these shale producers money to finance new drilling projects. They didn't see a problem with signing deals to pay a pipeline MLP huge fixed fees to transport their output. They were more concerned with securing capacity than a drop in crude oil prices. However, oil prices are now well under $50 per barrel in many of these markets. Profits and cash flows these small producers enjoyed a year ago are little more than a dream today. Banks aren't so willing to lend money to energy producers. In fact, many banks are now worried the collapse in oil prices will result in a growing pile of bad loans. Simply put, many of these shale producers can't pay their transportation bills. Even the producers on a relatively sound financial footing are looking for any way possible to conserve cash. Shale producers are starting to prepare for a prolonged period of lower oil prices. These producers are now going back to their counterparties. That's the midstream MLPs that own the pipelines and terminals, asking for discounts. Of course, the MLPs with these long-term contracts in place could refuse to grant discounts and insist on receiving their capacity reservation fees as agreed. But let me ask you, if their customers can't pay their bills and are forced into bankruptcy as a result, how much do you think these pipeline tariff contracts with MLPs are worth? Yep, that's right, absolutely nothing. Simply put, many of the high-yield pipeline MLPs will be forced to renegotiate their pipeline tariffs as shale producers struggle with falling oil prices. Look, as I just explained, it's only a matter of time before investors wake up to the fact that contracts signed with shale producers aren't worth much when those producers are struggling to pay their own bills. There's still an opportunity to get out of vulnerable names right now. However, that window is closing fast. Listen, Roger and I have assembled a comprehensive report detailing the most vulnerable, high-yield midstream MLPs called Ticking Time Bombs. These MLPs are hazardous to your wealth. Please let me send you a copy of this report with absolutely no risk or obligation before it's too late. I urge you to read this report before you buy any more midstream MLPs, and I'll explain how you can get a copy today in just a moment. Of course, even quality large-cap energy stocks like oil services giant Schlumberger will get hit in this downturn. While Schlumberger is a great long-term holding, you must buy this company at the right price. Schlumberger is only a great opportunity if you understand how the cycle is going to play out over the next few months. That's why I've prepared a second report, also available risk-free, called Schlumberger, Best in Class, but Exercise Caution, that explains in great depth exactly how you should approach buying stocks like Schlumberger. Simply put, Schlumberger is not a safe buy at current prices. Before you pull the trigger, I urge you to take a look at the detailed research I've assembled in our report called Schlumberger, Best in Class, but Exercise Caution. Profit step number 2, hedging your bets. What if I told you that one stock we recommend as a play on falling oil prices has soared 90% since mid-October alone? Or how about a sleepy retailer that's benefiting from falling gasoline prices? The stock has soared more than 30% since our recommendation in late November of last year. Would you be interested in hearing more about that kind of opportunity? Let's be honest. While the sector has performed well in recent years, energy stocks still account for less than 10% of the S&P 500. Many of the remaining 90% of stocks and sectors benefit from lower oil prices. However, only a small handful of these names are getting a game-changing boost from lower oil prices. The sort of tailwind that's already powered gains of 100% or more from some of our top hedge recommendations. I don't have time to go through all the details of our top plays on lower oil prices in this short video. However, I will explain everything in full detail in my new report called Hedging Your Bets, Stocks That Thrive When Oil Dives, and I'll gladly give you access to a copy absolutely risk-free. And I'll show you how to get this valuable report, again risk-free, in just a second. In addition, I've just prepared a brand new report on a weird little niche of the energy industry, a high-yield group that has been through a vicious down cycle since 2008. A downturn that resulted in several bankruptcies among major players in the sector. However, this overlooked energy subsector is now quietly entering a brand new upcycle. While most pundits busy trying to call a bottom in oil prices, few are even discussing this group. This is an aggressive recommendation that's definitely not for everyone. However, the last time this group entered an upcycle between 2002 and 2005, some stocks in the group offered returns of more than 2,000%. Look, I know you're probably thinking I'm exaggerating and that this sounds way too good to be true. And to be fair, I'm not looking for gains that large over the next 12 months. But my research points to potential gains of 50% to 100% in the best positioned stocks in the group. Look, I'm talking about the crude oil tanker industry. I don't have time to explain exactly why I like this group in this short video. However, I'll give you all my research in a hot-off-the-press special report called High Yields on the High Seas, Profit from the Turnaround in Tankers. I'd like to send you this report, including the names of my top tanker stock to buy right now, also absolutely risk-free. And while I think many energy stocks are dangerous investments right now, there are a few groups that represent fantastic value, which brings me to profit step number 3. Pull these babies from the bathwater. How about the names of a handful of tax-advantaged, high-yield stocks that have been caught up in the energy price panic? A classic example of Wall Street throwing the babies out with the bathwater. These stocks are down, but for no good reason, offering investors the opportunity to lock in high, fast-growing yields by purchasing these stocks at deeply discounted prices. I'm talking about yields of 4%, 5%, and even over 7% from rock-solid income gushers with the potential to generate significant income growth over the next 3 years, regardless of where oil is trading. In our hot-off-the-press special report called Game Plan for Lower Oil Prices, Pull These Babies from the Bathwater, we'll unveil all the details of 5 of our top picks to buy right now at fire sale prices. Plus, I'd like to send you information on a secret high-yield asset class few are talking about. An asset offering yields of 13% or higher that can actually benefit when some energy stocks are forced to cut their dividends and distributions. Profit step number 4. Profiting from the pain and collect a 13% yield. I've got to warn you, some pundits are actually telling investors to avoid this asset right now. Yet these securities offered huge returns the last time energy prices fell in 2008 and 2009. We expect total returns of 50% or more over the next 12 to 18 months. This opportunity is a little unconventional, but has been a favorite of wealthier investors for decades. I'd like to give you access to this valuable report, detailing this secret asset class and strategy, also absolutely risk-free. I'll show you how to get it in a second. And that brings me to our 5th and final profit step to take right away. Profit step number 5. A certain winner in uncertain times. Our favorite new MLP. Master Limited Partnerships, or MLPs, are a group of tax-advantaged, high-yield investments that have blown the S&P 500 out of the water over the past decade. Over the past 10 years, the industry benchmark Alerian MLP Index has soared 300%, compared to a gain of less than 118% for the S&P 500. However, we've identified one simple characteristic you can use to identify the top-performing MLPs. One MLP with this simple trait soared 1,160% over the past decade alone. That's enough to turn a $10,000 investment into nearly $120,000. Another MLP we identified with this same golden characteristic has jumped over 150% since going public just over 2 years ago. That's close to 5 times the return for the S&P 500. You'll be shocked at how well this one simple trick for identifying the top-performing MLPs works. And we've included all the details of this strategy and one of our top MLPs to buy right now in our special report available risk-free for a limited time. Please just give the work I've done a look. Read my 7 special reports, and I believe you will have all the information you need at your disposal. The best part is you can take a look at my research and receive everything I've mentioned here at absolutely no risk or obligation. Simply let me know you'd like to take a trial subscription to our service, Energy and Income Advisor, and I will immediately give you access to all 7 of our newly released research reports. Click the green Subscribe Now button below this video and test our service for 30 days. Download all 7 of our special reports. Read 2 detailed monthly issues of Energy and Income Advisor. Gain exclusive access to our model portfolios, offering suggested allocations for growth, income, aggressive, and conservative investors. Read through our extensive archives. Now let me ask you a simple question. Wouldn't it be great to be able to pose any question you like about the stock market, economy, or individual stocks and bonds and have your questions answered? Let me tell you about our monthly web chats, a feature of our service Roger and I pioneered a decade ago. It is still the most popular feature of the Energy and Income Advisor service. These chats are an opportunity for you to ask us any question you wish about stocks, our recommendations, the economy, or the broader market. Ask any question you like, and we'll answer every question we're asked on the chat. Last month, we were online for more than 7 hours, answering questions posed by our subscribers. Our next scheduled online chat is coming up in just a few days, just enough time for you to read our research and prepare any questions you have. Click the green Subscribe Now button below this video, sign up for a risk-free trial subscription to Energy and Income Advisor, and we'll rush you the details of how to log on to our exclusive subscriber-only online chat. We believe there's no better service on the market today, and all we're asking is that you give us a fair try and see for yourself. If you don't believe it's worth every dime of the subscription price, cancel in the first 30 days to receive a full refund, no questions asked. What have you got to lose? Test our service for 30 days, read our research, and join our monthly web chat, then decide. If Energy and Income Advisor isn't for you, cancel in the first 30 days, keep your 7 free reports, and I'll refund your full subscription price, no questions asked. Here's to your wealth. To start your risk-free trial, please click the Subscribe Now button to the right of this video and join us today.